The longest yield curve inversion in history has finally ended. Today we are going to talk, and I've discussed this in other videos, but we're going to refresh what exactly is a yield curve, what is an inverted yield curve, and what does this news about ending mean for long-term investors. So first off, what is a yield curve? Well, a yield curve is just a simple way of saying, or a complicated way of saying, how much am I willing to accept for my shorter term bonds? So if I'm going to lend you money for a year or 30 days, in other words, a short period of time, how much do I want? Versus if I'm willing to extend it and lend it to you for a longer period of time, 10, 20, 30 years, how much interest am I going to expect then? So typically a normal yield curve, so not an inverted yield curve, but a normal yield curve is going to be sloping up and to the right, like this chart. So typically, if you're going to be locking up your money for a less period of time, you are willing to accept a lower interest rate. As you tie your money up for longer periods of time, naturally you would expect a higher rate of return to tie up your money. That is a normal yield curve. What is an inverted yield curve? Well, an inverted yield curve is where we've been for the last 2 years, which is record setting. Typically, the yield curve is not inverted. It is just normal, which is up and to the right. We have been in an inverted yield curve situation, which means you are getting a higher rate of return by tying your money up less. And so short term, like money markets or 3 months, 6 months, 12 months, is actually getting you a higher rate of return than tying your money up for 10, 20, 30 years. So in that situation, an inverted yield curve, it actually starts high and goes down, right? So it's the opposite of a regular yield curve. So that's an inverted yield curve. It's just going the other direction. And again, another way of saying that is you earn more money not tying it up. You earn more money with shorter term rates and shorter term bonds. And so the news has been coming out. The inverted yield curve is now ending. Why are they saying that? Well, it's kind of a technicality here. When you think about an inverted yield curve and you said, well, okay, shorter term and longer term, that could really be a lot of things. Which short term bond are we looking at versus which long term bond? And a typical or a technical way to look at it is many people use the 10-year treasury bond and the 2-year treasury bond. So they use the 2-year for the short term, they use the 10-year for the long term bond. And in an inverted yield curve scenario, the 2-year treasury makes you more money than the 10-year treasury. So you can tie your money up for only 2 years and you get a higher rate of return per year than if you tied it up for 10. That's an inversion or an inverted curve. Just look at those 2 points. And recently, we're in September, October of 2024, that is turned back. That the 10-year rate of return you can get is slightly higher than the 2-year rate of return. So it's no longer inverted technically using the 10-year and the 2-year. However, what does the yield curve look like if we expand it? Not just look at the 2-year bond and the 10-year bond, but look all the way from super short-term money, like 30 days, to long-term, 30 years. So a true yield curve look, rather than these 2 tiny points. What happens when we look out? So when we look at this chart here, what we see is, now remember, a regular yield curve, which they're saying we're no longer inverted, goes up and to the right, and an inverted yield curve goes down and to the right. Now, as you can see, when we look at the full yield curve, short-term money all the way to the long-term money, what you can see is this is absolutely not an up and to the right chart. So when we say the yield curve inversion has ended, right, and you see these 2 little data points where you look at the 2-year and you look at the 10-year, that's all these are, is anecdotal data points when it comes to a yield curve ending. It is still short-term money makes you more than long-term money. There is no way around it. And now why are we talking about this? Why am I spending so much time discussing this technicality? Is because many economists or talking heads on TV and many good intentioned investors view an inverted yield curve ending and going to normal as a sign that a recession is coming. And what is the technical definition of a recession? We've talked about it before. We'll probably talk about it again in future videos. It is a couple of consecutive quarters of negative GDP growth. Okay. So does an inverted yield curve ending signal a recession is coming? I'm going to say no. First of all, A recession doesn't exactly mean your investments are going to go down. We've discussed that in prior videos, that GDP tracking and your stock market, they do not move like you would think they would. So it doesn't signal your portfolio is in danger, but it also doesn't necessarily mean that we're going to go into a recession, because as you have seen, even if you thought this technicality or this yield curve inversion thing were true, and you look at all the way from the short term 30-day to the 30-year, this curve is not inverted. The short term, you are still getting a much higher rate than your long term. So all the way from what is the biggest picture view of your yield curve, you'd be looking at 30 days, which is over 5%, to 30 years, which is under 4%. So it is still very inverted, which is an overly complicated way of saying, one, these are all technicalities when you're hearing this on the news, what is a yield curve, right? And then the other is, it doesn't necessarily have an impact on you as a long-term investor anyways. So this is my way of taking several minutes to say this is something that you might hear about, and it's one less thing you have to care about. I hope you found this helpful, and as always, thanks for investing your time with the Personal CFO.